Welcome to module number 4, where we are going to explore the equity-settled share-based payment transactions. In this module, we are going to cover the following: the accounting treatment and the determination of the fair value, and how to recognize the expense over the vesting period. Equity-settled share-based payment transactions involve the issuance of equity instruments to employees or other parties. Let's look at the accounting treatment. When the equity instruments are granted, the entity recognizes the fair value of the instruments granted as an expense over the vesting period. This recognizes the cost of the services received in exchange for the equity instruments. On the other hand, if the entity provides these shares to acquire assets, so in this case, the debit side will not be an expense account, but will be the asset account itself that was acquired. One critical aspect is the determination of the fair value of the equity instruments granted. There are various valuation models that we can use in this regard. One of them is the Black-Scholes model, and this model can be used in order to estimate the fair value of the options. This fair value represents the cost of the services received. And if you are asking about the Black-Scholes model, should we explain and should we understand, should we calculate the fair value using this model at our exams? Actually, it is not required at your exams for the diploma of IFRS to explain or calculate the fair value of the options using the valuation models. You will be given the information regarding the fair value of the option as part of the given information at your exam. So no worries about how to value the options. It's not required and it's not within the scope of the diploma of IFRS exams. Now, let's take an example to show how to account for these share-based payment transactions. Let's say that LMN Corporation grants 1,000 stock options to an employee on 1st of January 20X1. The options have an exercise price of $25 and the current market price is $20 and the expected volatility is 30%. Using the Black-Scholes model and this expected volatility, we assume that the fair value of the option is determined to be $8. Therefore, the total fair value of the options granted is 1,000 options times the $8, which is the fair value per one option. So the total fair value of the options granted will equal to $8,000. Now, what will be the accounting entry that LMN Corporation records for this transaction? Before we discuss this accounting entry, let's go back to this example and ask ourselves, do we have a vesting period? Based on the given information for the LMN corporations, we don't have vesting period and we don't have vesting condition. So we are going to give the employee the options today without any condition. So in this case, the total value will be considered as an expense in the current reporting period. So debit share-based payment expense with $8,000 as a value for this side of the account. And the credit will be the share-based payment reserve with the same value, $8,000. So why I'm using here credit as a reserve account in the credit side? IFRS number 2 didn't specify which account in the equity should we use in the credit side. So it gives us the option to select any account in the equity, but in practice, we used to create a reserve account for these share-based payment transactions. So the credit will be to the option reserve in this case, which is $8,000. This entry reflected the cost of the services received, and a reserve is established to account for the equity instruments that the company is going to issue. Now, let's discuss how to recognize the expense over the vesting period if we have vesting period in our situation. So in this case, the expense is recognized systematically over the period during which the employees are expected to provide services, which is called the vesting period. So what we are going to do now, we are going to take a simple example that we only have vesting period and we are assuming that all of the employees will continue working until the end of the vesting period. So this is a very basic example and a very hypothetical situation because in practice, maybe the number of employees who are going to continue or expected to continue employment until the end of the vesting period might differ from our original estimate and the total number of employees. So we are going to take simple example at the beginning, and then we are going to take more examples, reflect the practical case studies that we might face in the real world. So let's take simple example to show the accounting entry year by year, assuming that all of the employees will continue working until the end of the end of the vesting period. Assuming the stock options from the previous example have a vesting period of 3 years. So I will stop here and comment on this part. Here we have a requirement for all of the employees to continue working until the end of the 3 years. And whoever is going to continue working until the end of the 3 years period, they are entitled to receive the stock options. So as of today, we have to build our accounting and entries based on assumptions and estimates regarding the number of employees that we estimate that they are going to continue working until the end of the 3 years period. The annual expense recognition in this case, and because we are assuming the total number of employees will continue working until the end of the vesting period, so we are going to split the total value of the options, which is $8,000, over the 3 years period. So each year we have to recognize an expense equal to $2,666. So for simplicity, we assume in this example that the probability of the employees to deserve these options is 100%, which means that all of them will receive and none of them will leave the company during the vesting period. But in the next examples, it will be more reflective of the real world scenarios. And we are going to discuss what if that not all of the employees will be able to continue until the end of the vesting period and some of them will leave. So what will be the case and what will be the accounting entries and what will be the calculations in this case. So stay tuned for other examples that we are going to take in this part to show real world cases and that reflect practical estimates and assumptions. So returning back to our LMN corporation, where they are assuming that 100% of the employees will continue working until the end of the 3 years. So each year you are going to recognize an accounting entry and record this entry, debit and the credit. Debit share-based payment expense with the same value, 2,666, and then the credit will go to the reserve account with the same value. It's worthy to mention that the expense account that we used here is considered as a part of the cost of the employment and will be reported in the statement of the profit or loss unless these employees contribute or participate in the development of another asset. So in this case, the expense or the value of this expense will not be reported in the statement of the profit or loss. We will not use expense account, but we are going to capitalize this cost over the cost of the asset that these employees are participating to develop it. This is in alignment with the framework of IFRS, stating that if employees are used or participate in development of another asset, so their cost must be capitalized as part of that asset. So returning back to the LMN corporation example, and we are going to assume that these employees are not participating in development of another asset. So the value will be debited to an expense account, and this expense will be part of the cost of employment and will be considered as part of the statement of the profit or loss. So each year we are going to record the same accounting entry. Why? Because remember that we assume hypothetically that 100% of the employees are going to continue working until the end of the 3 years period. So the balance now, after recording year number 1 entry and year number 2 accounting entry, the balance now in the accumulated share-based payment reserve will be $5,333. This process continue until the end of the vesting period, which is year number 3 as well. So to summarize what we discussed in this module, the fair value of equity instruments granted is recognized as an expense over the vesting period, as long as the employees are not participating in development of another asset. And determining the fair value often involve using valuation models such as Black-Scholes model, and you are not required to calculate the fair value at your exam. It will be given as part of your given information in the example or in the question. Finally, the expense is recognized systematically over the period during which the services are expected to be provided. In the next section or in the next module, we are going to cover the second type of the share-based payment transactions, which is cash-settled share-based payment transactions. Join me in the next module.